My dad was actually an entrepreneur in his own right. He was always very actually encouraging of me to tinker with stuff. I owned the badge of honor of being the last summer analyst class of Merrill Lynch, basically. Ultimately, the initial incarnation for Percent was to be a better alternative investment platform focused specifically on private credit. Since then, we've evolved it into what it is today, which is actually more like debt capital markets infrastructure to support borrowers, to support underwriters, and to support investors in a way that just never really existed before. So we like to call it the modern credit marketplace, effectively.
Welcome to Value Add, your edge in building wealth. Hey everyone, thanks for joining. Today we have Nelson Chu, founder and CEO of Percent. Hey Nelson, how are you?
I'm good. Thanks so much for having me.
Thanks for coming on and thanks for making the time. So Nelson, before we dive into the story of Percent and how you kind of started it, would love to hear more about your background and how you got into the private credit market.
Yeah, absolutely. I think accidentally is probably the right way to look at it. I definitely don't come from a debt capital markets background, that's for sure. It's good to rewind a little bit back to when I was growing up. So I grew up in like central New Jersey, nothing too crazy in the suburbs, right? Standard middle class upbringing. My mom was pretty traditional. And so she wanted me to go to an Ivy League school, be a doctor, lawyer, or banker, figured that'd be the path to be set for life. And then my dad was actually an entrepreneur in his own right. So he actually
Yeah.
co founded a software company with a bunch of his friends in the airline crew optimization space, which is a very
Okay.
niche field, I'm not going to lie. So back in the 90s, when you were flying on a flight, the flight attendants and the pilots on that flight were actually scheduled via index cards and whiteboards. I'm not even kidding. It's like really bad. I'm pretty sure Southwest is still using index cards and whiteboards based on everything that's been going on. So there's that. But they
Okay.
created software to be able to help facilitate crew scheduling through maximizing priority, preferences, seniority, FAA regulations, union laws, things like that. So
Right.
total global revenue of like 50 million bucks, maybe something like that. They got
Okay.
like 8 of that, which is like not bad in the grand scheme of things. So he was always very actually encouraging of me to tinker with stuff. So I had bought a Mac in 1999 before Macs were cool because he was encouraging me to do that. I taught myself Photoshop, taught myself movie making, pretty much nothing that was academic I was probably interested in. When I graduated high school, I had to go to college, did not go to Ivy League school. Mom was super disappointed. I ended up graduating 3 years with a double major and a minor in econ, poli-sci, and philosophy. So like a
Okay.
little bit academic ultimately. Then graduated from college and went to finance. So that was like my first foray into finance. Mom was absolutely thrilled. Unfortunately, I graduated in 2009. So interesting time to be joining traditional
Good
finance.
time.
I owned the badge of honor of being the last summer analyst class of Merrill Lynch, basically. After that, became Bank of America. I was on the business intelligence side for wealth management. It's definitely not debt capital markets. After a year and a half, everyone was like, you should go to the buy side. Buy side's better than the sell side. I was like, all right, that's fine. I'll go join the buy side. So I picked the largest buy side shop on the street, still is, in BlackRock. I joined the operations side of fixed income portfolio management, where I learned nothing about fixed income, just to be perfectly clear. After a year, I was like, I'm done with this. I don't want to do finance ever again, which is clearly very famous last words because look at what we're doing with Percent, obviously. So from there, started my own company, tinkered around with stuff, tried to figure out what I would be when I grew up. I ended up launching a consulting company that helped other founders build their companies from the ground up. So we gave them all the resources from product to marketing, to branding, to engineering. Had a couple of unicorns come out as case studies and clients coming out of that, which was fantastic. And they got the itch, right? After like 5 or 6 years of doing that, I was just like, you know what? We have like a team that knows how to build companies. We have good ideas. We know VCs. We should just do something the venture backed way, if that's the case. That's kind of how Percent came to be. So the clients that I had on the consulting side were still very fintech oriented because they saw my background.
Yep.
They were just like, oh, you could do a financial model. You know how to like write a deck. This is great. Like, let's do this. That's why we always were in and around the hoop for fintech. Ultimately, the initial incarnation for Percent was to be a better alternative investment platform focused specifically on private credit. Since then, we've evolved it into what it is today, which is actually more like debt capital markets infrastructure to support borrowers, to support underwriters, and to support investors in a way that just never really existed before. So we like to call it the modern credit marketplace, effectively. But I've just fast forwarded you through like 34 years of my life. So yes.
A lot to take in. So interesting. You graduated during the financial crisis, went through banking from sell side to buy side. You took the traditional path initially, then you got the entrepreneurial itch. Tell me a little bit more about the consulting company. What was that about? Where were you finding clients? What kind of problems were you solving?
The backstory that I glossed over very quickly was that I attempted to start a startup after quitting BlackRock. Because I was like, how hard could this possibly be? New York tech
Yep.
ecosystem was taking off in 2012. I realized in like 6 months how hard it actually was. I had burned through all the cash I had saved up from finance, and I was literally broke and I could not make rent the next month, like straight up. So when you're broke, you become a consultant. That's kind of like the natural segue there. You just sell your services, right? Like, why not? So I had actually put myself up on Odesk at the time, which is now Upwork. I just said, you know what? I could do financial modeling for you. I could do a pitch deck for you, whatever you want, just ping me. So on a
Yeah.
random Friday night where I was obviously broken at home, I got an email from Odesk saying, hey, this person wants to talk to you about a pitch deck. And I was like, that's a Friday night. I don't know if I want to be doing this right now, but I'm also broke, so I should probably do this. So I looked
Yep.
at the person, I looked them up. It was like a VC on Sand Hill Road. So in my head, I'm like, why are you reaching out to random people at Odesk to do a pitch deck? But fine, I'll definitely talk to you. Spoke to him, had a really good conversation. He was like, you have a pretty good grasp of startups. I'm not going to lie. I said,
Yeah.
yes, I'm a failed founder from like trying to do this for 6 months. So over the weekend, banged it out like 36 out of 48 hours, just cranking through that deck. He raised 6 million within a Monday. And then that Monday, he was just like, I have an entire portfolio of companies that could use your help. So we're off to the races. And at that point, it was just kind of iterating from there. The interesting part about telling a story and doing a pitch deck is that you build a really good rapport with the founders. You
Yep.
feel like you really understand their business. So when they raised their money, because they were very successful with the decks that we had created, they had to come back to us saying, hey, can you do like mobile app design? Can you do like branding? Can you do marketing? I was just like, oh yeah, I got like all the people you need for all of these things. Then from there, I just hired people. So we capped out about 15 people all in terms
Okay.
of product managers, designers, marketing people, and engineers. We just gave resources to be able to get them off the ground. We specialize in early stage companies because that's where we could add the most value. Oftentimes, I angel invest in a lot of the companies as well. Some of them did really well. So it was a great learning experience. Got a crash course in product management, building products, design, things like that.
Yep.
At Percent, I was the only designer at the company for a very long time because I had to, because it was just trying to conserve budget and resources and burn.
Yep.
Thankfully, that's not the case anymore. And magically, the products now all look better. We have an actual designer. But either way, it was a good run. That taught me a lot. And I learned a lot from the mistakes that I've made on the consulting side that
Yep.
now at Percent, you just make less mistakes, like having done it all over again.
That's awesome. It's interesting that you had an intention to start a company, failed at it, and then out of nowhere, opportunity came in. I feel like that happens to a lot of founders. You kind of burn out, you maybe go broke, then out of nowhere, an opportunity might come out and that might spark something. As long as you're kind of doing and delivering, I feel like you find your niche, right? I actually did something very similar, but I'm not going to talk about that too much. But I quit my job with an intention to start a company, failed at it, and I just started doing stuff. And now, fast forward, I'm doing this
And look where you are
temporarily.
now. Yeah.
Yeah, exactly. So great story. Let's dive a little bit into private credit investing. So for those of us who might not be familiar with what that is, first, if you can just define what the market is.
Yeah, let's do a little bit of private credit 101.
Yeah.
So, private credit is something that you probably don't know what it is specifically, but you very likely have interacted with it.
Yep.
Private credit encompasses so much of what we do today. So, for example, small business lending, if you didn't get it from a bank, it's probably private credit. Consumer loan, if you didn't get it from a bank, probably private credit. So, like buy now, pay later is firmly in the private credit camp. Earned
Yep.
wage access, advancing your salaries, like that's private credit, right? So, all this came to be, it's been around for like decades, but all this came to be post global financial crisis when the
Yep.
banks really took a step back away from lending activity because it became a
Yep.
lot more expensive for them to do that. And you had all these non-bank lenders coming out of that and pair that with a low rate environment where the Fed kept rates super, super low. It was easy to
Yep.
lend. You all now had a good spread you can make off of that. And VCs just poured money into non-bank lending effectively. So non-bank lending is firmly in the private credit camp, where if you ever took out something from a firm or Klarna as a buy now, pay later loan, if you took out a
Yep.
student loan from SoFi before they turned public, those are all private credit in the wheelhouse of private credit. The reason why it works is because they don't have a balance sheet. That's how they differ from a bank. So a bank would lend off their balance sheet to be able
Yep.
to kind of facilitate these loans, knowing that the interest they earn from you is going to be higher than what they're paying out to depositors effectively. Pretty simple stuff. But
Yep.
depositors' interest was next to nothing for the longest time. So they could actually make quite a good spread on that, right? Now the rates have come up a little bit. And so the non-bank lenders are feeling the pinch a little bit in the sense that because their cost of capital is higher because they're not a bank, they don't have a balance sheet, they don't have depositors, they have to raise
Yep.
money from credit funds. And credit funds aren't looking for 2%. They're looking for like 10% or something like that. Now they're looking probably like 15%. That is going to kind of trickle over into how much margin these non-bank lenders can make off of these loans. But still, that's kind of the gist of private credit, essentially.
So what was your motivation behind starting Percent and focusing specifically on this market?
So there's a couple things. Back in 2017, 2018, because we had done a lot of consulting for fintech companies, we just saw the landscape pretty well.
Yep.
When looking at two different things that were appealing or interesting, alternative investments, clearly here to stay, right? So we wanted to do something in that space. And
Yep.
also from a investment platform standpoint, a lot of different options out there. But for the latter, it was a little bit interesting because it didn't seem very investor friendly. Like the durations that you'd have to put money and lock money up was like
Yep.
4 to 5 years. Not the most friendly for investors. the minimums were like pretty high, like 25, 30 grand, right? So if I don't know who you are and I'm giving you 25, 30 grand for 4 to 5 years where you may not be around at that point in time, that seems kind of suspect. The yield you could get was either totally unpredictable or around 9 to 16%. Everyone was kind of around the same thing. So we thought, interesting. So if we can do something that's much more investor friendly, if we can do something that is a shorter duration investment, call it like 1 month or 2 months or 3 months, we can also do something that's a way lower minimum to make it way more approachable, like $500, then that could be really interesting as long as we clear that 9 to 16% hurdle effectively that everyone else
Yeah.
seems to be doing. And from a asset class standpoint, you had our pick, right? We could do equities, but that's pretty packed, right? There's like seed investors like AngelList or
Yeah.
Republic. It's just really crowded. For real estate, there's also a lot out there. We didn't see a lot in private credit as one option. Also, we like the predictability of private credit. Private credit realistically should pay you interest every single month.
Yep.
Equities, good luck with that. Real estate, it depends, right? So we like the predictability. We like the ability for us to be able to kind of do that short duration type product. And that worked out really well for us. So that's sort of where we saw the multiple options available to us. We kind of honed in on the ones that we thought met the attributes that could create a successful foundation for a company, knowing full well that that's the idea on the napkin. Where you end up as a company is very oftentimes never what you put on the napkin, but you just got to have a good starting point, right? So we knew that
Yep.
we could build a decent business off of this. Now let's figure out how to make it into a great business.
Interesting. So how are you able to provide more liquidity into this market, or how are you providing those returns for such short durations?
Yeah, so private credit naturally is shorter duration period, right? So it's not like
Yeah.
a public bond where it has like a 25, 30-year maturity. For
Yep.
private credit, it's way shorter. Oftentimes the structure is built so that borrowers are incentivized to want to be able to come back out to market. Because all these guys, what they want to do is grow, right? They want to take their first million, they want to take a 5 million, they want to take 10 million, then 15, then 25, then 50, then 500 or something like that. That is the path. So you don't want to have something that's out there for 5 years and then say, okay, 5 years later, I'm going from 1 to 5. That's not how it works. So the incentives are almost aligned between investors and borrowers because the investors want shorter duration. The borrowers also want shorter duration to be able to grow their portfolio. And that means that if you can do it properly, you can match them and pair that up very well. So the duration alignment on that side is great. The assets themselves also are shorter duration. You have a lot of these loans, like buy now, pay later, could be like 3 months, 4 months, right? That's not
Yep.
too crazy in the grand scheme of things. So all that makes for a really interesting proposition where if you can structure it properly, then you align the incentives of all the sides that are involved.
So what kind of assets are these credit products backing?
There's two parts of private credit, or two segments, if you will. One is what we
Yep.
call asset-backed securitization. So literally
Mhm.
assets backing the thing. Then you have corporate debt, right? Corporate debt is just pretty much one company, one counterparty. You're banking on the
Right.
fact that they stay profitable, or you're banking on the fact that they can raise more money as a venture-backed company. One or the other, effectively.
Yep.
So the asset-backed side is probably the one that's most easily understood from a sort of what are you backing, essentially. So for example, buy now, pay later loans, that's just an easy one to look at. You're essentially investing into a pool of thousands of BNPL loans. And you're looking at the
Yep.
performance and saying, okay, on average, like 20% of these default and they stop paying, like 80% of them perform. If that's the case, then I'll advance you 60 cents on the dollar, essentially, for all the loans that
Yep.
are out there. You can do with that what you will, right? And layer in all these different structures to be able to make that work. So within the asset back side, there could be small business loans on that side. It could be consumer loans. You could be
Right.
factoring invoices. So factoring invoices is pretty well understood. It's like basically, I'm a granola bar company. I got an invoice from Whole Foods. There's no way I can fulfill $1 million. I'm going to factor that invoice, and then I'm going to be able to then produce the product. I'll pay back the lender. Whole Foods is happy, and then I make that difference between the cost of my loan and the actual invoice itself. Pretty standard stuff. You have litigation finance as well. Some people are really good at figuring out which lawsuits are going to settle, in which case they'll advance it to you ahead of time. Or you can do post-settlement financing where it's already been settled, but it's not going to pay for a certain duration of time. I'll give you the money
Yep.
now, UK spread. So it's such a broad market, and that's what makes it so exciting, right? Like there is so much that can be done on that side. And it's not just the US. Private credit is exploding all over the world, exploding in a good way.
Yep.
So you have Latin America, you have Africa, you have Asia, you have Europe, all of which have private credit markets, and they are booming at this point. So when you think about sort of why people like it right now in particular, it is a very recession resilient asset class. You have uncorrelated assets that perform or don't perform based on the underlying assets themselves. It's not tied to the macro environment. It's not tied to what the Fed is doing. It's literally just tied to whether these assets are good or not, right? So
Yep.
there is so much demand on that side. It's the reason why Blackstone, Apollo, Ares, KKR, these big guys are all doubling down on private credit because they see that as the only opportunity in this very volatile market.
That's interesting. They're pretty much the same assets, but looking at it from the credit lens. So why do you think that they're not affected as much from the macro environment? Interest rates going up, that affects, let's say I'm a small business owner, right? Now I have a variable interest rate, maybe private credit, maybe with a bank, whatever it is. All of a sudden, my interest payments are higher. That's squeezing my margins. So how exactly private credit sheltered from the macro environment?
Well, in the way it's structured as well, right? So you're
Yeah.
looking at like an asset-backed securitization. There's like 1,000, 2,000 loans, sometimes even more than that in that
Yep.
portfolio. You have a history of performance here, right? The only time that it didn't really go according to the history of performance was during COVID, where you had a multi-standard deviation movement on that side because no one could have predicted no cash flows. You just don't model that out, basically. You always
Yep.
model out like, oh, like, there could be like 40% of the portfolio doesn't pay and you'll still be fine, things like that. So zero cash flows, no one predicted that. That was almost like a litmus test for private credit and whether it could survive it. And fortunately, it did, and it did really well in that environment. But yeah, so you can structure this risk away. You can advance a percentage rate that is lower than what the value of the loans are. You can set
Yep.
up cash control accounts to be able to ensure that all the interest gets swept automatically and no one can defraud you. You have the ability to essentially say, I want to file UCC filings, perfect that security to make sure that I own it. Like all these different things are things that you can do that you're not just essentially as a bank saying, yeah, this is my loan portfolio. I'm basically naked lending to this consumer or naked lending to this
Yep.
small business, and I'm hoping that it works out. You can structure the risk away, and you can also see this stuff coming from a mile away. Yes, the Fed raised rates very quickly, but not so quickly that we couldn't see it coming and you couldn't see it in
Yeah.
the
Yeah.
performance. So
Yeah.
as these things come back out to market more and more frequently, you'll say, okay, well, performance was this in 9 months ago. It's this 6 months ago. It's this 3 months ago. So I can
Yeah.
kind of predict where this is headed, and I'm going to change the structure in a way that works to protect investors effectively.
Interesting. I would say the other time that people weren't paying down their debt would have been the financial crisis. So
Yes.
you had mortgage-backed securities. So this is full circle if you think about it, right? Mortgage-backed securities are essentially asset-backed securities. So if you look at that, we didn't see it for a mile coming. Obviously, the banking system is much more resilient right now. But how are you thinking about systemic risk that, I guess if I think about it, mortgage-backed securities were just not valued appropriately, right? So how are you dealing with that potential misalignment between the assets in these pools versus the actual valuation that you have?
I would say the technology has come a long way from '09, right? So you had a lot of like layer one infrastructure being built that has been really helpful in trying to understand exactly what is going on the underlying portfolio. Back in the day, you just kind of had Excel files being shot back and forth saying, oh, yeah, this is what this consumer is doing. This is how much they're paying. It's like, is that actually correct? Like, how are you verifying that information?
Yep.
Now, with tech and especially with fintech, you have the ability to kind of do all that stuff. And it's just much more predictable and much more real time. A lot of this delinquency stuff happens immediately. And oftentimes back in the day, reporting, you wouldn't get it till 30, 45 days later. So at that point,
Yep.
it's kind of too late, right? Writing's on the wall. You didn't move fast enough. We, even for us, do weekly surveillance reporting on every single borrower they have in our ecosystem and all of their assets that comprise the portfolio. So you can see this stuff coming very quickly. It's interesting. We see the performance change kind of in real time on some of these things as things happen. So, for example, we had a situation where we had a crypto lender, and the crypto lender bounced around a little bit with the price of Bitcoin. So there's that. But then there was a point in time where Bitcoin just crashed. And you
Yep.
saw the over collateralization that we had built into it. There is a situation where they had to kind of margin call the loans to be able to cover like the losses that were happening on that side. So you saw they did below OC and they margin called, and you see this all happen right in real time,
Yep.
which is really cool. So could you do that in '09? I don't think so. Like, I don't think that was going to be
Yeah.
possible back then. And you can do it now. That's kind of the value of where it's all coming together and culminating at the right time. The same way that private credit flourished during GFC, you're seeing it flourish now as well.
Awesome. That makes a lot of sense. So let's talk a little bit about your borrowers. You guys started in 2018, I believe. Why are borrowers inclined to work with you? What kind of borrowers are you working with? And if you can give us like a broad distribution of the types of borrowers you worked with over the past years, that would be great.
Yeah, absolutely. So we started off, as much as I would have loved to compete with JP Morgan on a deal and do a large ABS deal, there's no way we would have won that fight, right? So we actually started on the ABS side, first and foremost, because it is a harder transaction to do. Like ABS requires asset level structuring and corporate level
Yep.
structuring versus corporate debt is just corporate level structuring. So we figured we could do the hard stuff, we could do the easy stuff later. On the ABS side, we started small because we couldn't compete with the big banks. And so we focused on pretty much fintech lenders. That was sort of our bread and butter. We had all different things around, like all around the sun. So we had small business lending, consumer loans, factoring, all those asset classes I shared with you. We
Yeah.
essentially created the standardized template to be able to facilitate transactions on all those things. We created standardized reporting to be able to monitor performance on that side. We did all those things to be able to kind of make that possible. And then we used that to be able to get to where we are today, which is the ability to scale to any asset class within private credit effectively. It's been an incredibly powerful experience. We added corporate debt in 2022, almost like accidentally. But we just felt ready at the time to be able to do it.
Yeah.
Now it made for a interesting opportunity where everyone needs venture debt right now, and it actually
Yeah.
worked really well for us. So sometimes you need a little bit of luck, sometimes it's opportunity, sometimes it's a little bit of both, and it's been great for us to be able to do that.
Gotcha. So in terms of like the corporate debt, venture debt, personal debt, all the different classes you talked about, what is the risk level that you typically deal with looking at corporate, dealing with like AAA, but I wouldn't assume you are because you're not going to get some great returns on that. So what is the level of risk that Percent is comfortable with putting on their platform?
So what we've essentially done is created almost like the market standard for private credit. You actually don't really see that anywhere else. So historically, when you look at public fixed income markets, everything's kind of structured pretty similarly. Right? You can have a
Yep.
ratings agency come in and say, "Oh,
Yep.
that's an investment grade deal. That's a high yield deal," because you can see the structure and you understand it. That's why they can do $1 billion issuance in like 24 hours, which is unheard
Yep.
of in private credit, obviously. We're kind of trying to do the same thing here, enforcing market standards to be able to actually make these deals happen a lot more easily and bring that transparency out to investors at the end of the day. That is kind of the name of the game. So you have an investor now who can take a look at all the different things in their portfolio that we have in terms of offerings, and they can say, oh, this one is structured this way at that level of yield because it has this level of default rate, this level of first loss coverage, this level of advance rate. You can kind of keep comparing them side by side. So it
Yep.
really is something that we're enforcing to be able to make disclosure and transparency as simple and standardized across the board. And then investors can make that decision. So for sure, the higher yielding stuff is higher risk. Lower yielding stuff is lower risk. It kind of goes hand in hand. And
Yep.
investors have the ability to use these sort of comparison tools to decide what is the level of risk that's palatable for them. Our job is really more to be an infrastructure provider than anything else. So we're going to syndicate things as long as they meet a baseline of like legality and legitimacy, as in they're
Yep.
not fraudulent, as in like the business actually exists and we check all those things as part of onboarding. Then you have the ability to then actually give investors the opportunity to decide what's good for them effectively.
Got it. So you provide full transparency. And that's pretty awesome. I was digging into your platform a little bit and it does seem like it. And it's pretty cool to see. We mentioned Moody's a little bit. Are you guys also providing like a percent rating that kind of aggregates that due diligence?
That's a great question. So as of today, we are not, because we actually still have some deals that we have underwritten over the years that we're maintaining that relationship for. So we need to remain independent and we can't provide a rating if we are still doing deals. That's just not fair, ultimately. In the future, if there's an opportunity to fully sunset our position as an underwriter, then we can potentially explore either providing a rating or leveraging third parties to provide ratings and have it be completely independent in that instance. It's something that we're keenly looking at. It's something I think would add a lot of value for investors as well, just to kind of get a baseline level of expectation for how this was structured, essentially.
So I think we talked about your borrowers. We talked a little bit about your products and the risk and the structure of your deals. What about your investors? So what are your typical investor profiles from retail to institutional?
Yeah, for sure. We definitely started off more retail oriented, right? I think most platforms do. We had several thousand retail credit investors who've signed up, been interested in the products, been active investors over the years. The average investor stays with us for at a minimum of 24 months, which is pretty good in the grand scheme of
Yeah.
things. We've only been around 4 years, right? Technically, that's not bad. The number continues to grow. Recently, though, because of the volatility in the market, it's not really for the faint of heart. And I think retail in general tends to be a little more skittish when it comes
Yep.
to market volatility. We've seen instead family offices and credit funds double down because they're seeing opportunity. They understand the recession resiliency of private credit. And we're seeing a
Yep.
lot more demand on that side than ever before. So that's been fantastic to see. So we've really pivoted our approach to be much more family office and credit fund oriented versus retail investor oriented in this market in particular. If the equity markets stabilize and things start to look like they're on the up and up again, retail will come back and we're ready for them whenever they are. But right now, it's just really doesn't seem to be the sense that that's what they want at this stage.
That makes sense. That also gives you a lot of stability, I would imagine, in terms of your investor base, because retail, as you said, could be quite volatile, whereas institutional investors have goals to meet. So when you're working with institutional investors, are you looking at more like family offices
Yeah, for sure. Credit funds as well. They
or credit
both
funds?
like private credit, right? In many ways, we've created investment products that are suited for where they are and what they like. So, for example, Retail tends to like sort of managing it themselves and investing
Yeah.
in direct deals, things that are interesting for them that pique their interests. For family offices, they kind of don't want to manage everything on their own. Like they just want to
Yeah.
set it and forget it. Give me private credit exposure. Let's call it a day. So we created what's called a blended product. A blended product essentially says, okay, these are the criteria that I had. And we can do this because we
Yeah.
created that market standard, right? The advance rates, the OC levels, the UCC filings, the cash control accounts. They can say, I want US only, senior only positions with portfolio losses less than 5%, with advance rates under 80%, with a cash control account that reports asset performance weekly. That's my criteria. Now make me a product. And we can create an algorithmic product for them that deploys into every single deal that fits that criteria up to a certain threshold. So not one deal is taking up like 85% of that deployment. That's a
Yep.
very family office RIA oriented product, essentially. So that's great. Now, we also have credit funds on the platform. Credit funds aren't always able to invest directly and aren't always able to invest via that blended note. So there's exploration of maybe we could do a credit facility for them that actually fits their need. Same thing. These are the eligibility criteria based on your market standards. Then now everything that fits that bill, I'll add into the facility and then we'll call it a day. So really it's meeting investors where they are with the products that they are best suited to invest in and the vehicle they can invest through.
That's super cool. I want to talk a little bit more about retail investors again. I assume looking at your product that you're only open to accredited investors right now. Would love to hear your thoughts on one, accreditation, two, is this product suited for non-accredited investors? And if so, when might that happen? Three, broadly, your view on whether people should have access to accreditation or not, or accredited products.
So I'm a firm believer and supporter of accreditation. I don't think investments should be made for everybody, to be perfectly
Yeah.
frank. There's a lot of risk that comes with these, and there's a lot of chance that this could go to zero directly. It's
Yep.
not a set and forget it and one and done type situation
Yep.
versus like the stock market. You can watch it go all the way to zero, but I would hope you're smart enough to pull it out before it goes to zero. You can see it coming, right? Or that was the risk
Yeah.
you chose to take. So accreditation sets up a barrier that is good and a gate that's good, I think, more broadly for the industry. The
Yep.
SEC is trying to get better at it as well. So they know the gate's a little bit too high potentially. And that's why they added the series license. So literally, if you work in the industry, you work in finance, you have a lot more options to invest because you're probably
Yep.
savvier as an investor, to be honest, because you work in finance, right? For people who don't work in finance but want to get accredited, they can also just take the licensing test on their own, essentially. Like it doesn't mean you have to use a license, you need to get licensed effectively. So
Yes.
all that makes for I would argue, a good gate that I would like to see stay there. Having said that, I mean, you look at public market fixed income right now versus private market fixed income. Like, why would you ever invest in public market fixed income right now? It doesn't make any sense, right? So if you want
Exactly.
any sort of credit exposure, it's got to probably come from private credit. And you just need to be more discerning about it. You got to do your own research. In this instance, that's why we always like that blended note product I was mentioning to you, because it gives you that diversification. And we knew that as well. So we do offer that blended note product to retail investors as well, based on
Yep.
us setting the theme. So we may say this is a US only blended note, this is a senior only blended note, this is a high yield only blended note. Investors can't tell us what they want for their criteria. They just have to invest in that product. There's always going to be 10, 15, 20 different borrowers and deals within each of those notes to give you that diversification, just so you can better protect yourself in the event something goes south.
I think credit in general can be a risky product. So as you said, stock market is actually very risky. If you look at crypto, anyone can invest in crypto, can lose a ton of money. So there are a bunch of public market assets, and when times are bad, all of them seem to correlate. So I think broadly investors would benefit from access to the private market, but as you said, there have to be guardrails in terms of education. And I think the guardrails that the SEC has right now is like minimum, let's say, net worth amount or income amount that don't really satisfy the actual sophisticated investor requirement, right? I hope that changes over time. But at the same time, credit might be relatively in the middle in terms of riskiness. If you think about private market investing and you go all the way to venture capital or individual startups, which would be even more, which would be at the fag end of that scale. But then you also have real estate, you also have wine, you also have other asset classes that a real estate asset class will not go to zero per se. It might go down. It's less volatile in terms of private investments. I feel like there has to be some more delineation around education and access.
Yeah, exactly. You bring up a great point. So, crypto in particular, that's more of a Regulation's coming. Let's put it that way. Like
Yeah.
it should have been accredited investors being able to invest in that to begin with, but that would have
Yeah.
gated the entire world effectively.
Yeah.
So that is going to be something that's not long, I think, for how it exists and operates today. When it comes to collectibles and like wine and things like that, those are still risky in the grand scheme of things.
Yeah.
Also, because the information asymmetry is so broad there, it's super opaque. Like how this
Yep.
prices, how it performs. At the very least, with private credit, I can mark to market this investment based upon the weekly reporting that we do. If it's performing, then it trades at par, right? If it's
Yep.
not performing, you do a discount based on how much it's not performing by. You can easily create a secondary market for this stuff based upon the
Yep.
fact that it can be marked to market versus a wine bottle. You got to look at maybe it was last sold like 6 months ago. I mean, is that the best price right now? I'm not really sure because a lot can change in 6 months. Credit's just very different. And we like that about private credit. I'm not going to profess to be a genius and say we thought about this when we started this company, but it's kind of worked out that way that as we've dug deeper and deeper, we've seen the ability to build core infrastructure that actually can support a much more vibrant ecosystem that looks and feels more like the public markets than what it
Yep.
really is considered private market.
I want to pivot a little bit towards talking a little bit about the markets. You guys have been around since 2018, and we've had a pretty crazy market since then. I would think every year is different, right? 2019 would have been quote unquote normal, which now who knows what normal is. 2020 we had COVID. 2021 we had a COVID bull run. 2022 we had a crash. No, I wouldn't call it a crash, but we had interest rates going up because of inflation skyrocketing. Now, 2023, we have a quote unquote banking crisis where we're in the midst of it. Who knows where it's going? A few banks had to sell their assets. So every year has been different. So I'm curious to know, because that kind of experience, if you think about it, should happen over decades, right? So markets fluctuate that much historically from decades worth of being in the market. But in 5 years, we've seen a lot, right? So starting a company in that time and specifically private credit markets is what I'm curious about. How have you seen these markets perform in each of these individual years?
That's a great question. I think if I ever write a book about it, these will be the formative years of this book that kind of help shape who we are. It's interesting. We launched our platform publicly in like July 2019. We kind of took
Yeah.
any investor could sign up, they could do that, and all that good stuff. So we had like a 7 month run before COVID hit, effectively, which is not a whole lot of time. That was an interesting time for us. We were essentially battle testing our structure and how we were able to do it for the first few deals that we had done. We
Yeah.
actually performed pretty well. In peak COVID times, we had one default in that time frame out of all the borrowers we had. That's not bad, right? So that means that the structure
Good.
actually does work. One default that we had was the fact that underlying the securitization was a single borrower, effectively. And so
Yep.
that borrower had thousands of loans, but it doesn't matter if that you're still facing that one borrower, that borrower goes bankrupt. So we were in a junior position to Ares. You don't want to be in a junior position to Ares. They're always going to win. We also learned that single obligor exposure is super risky in a securitization type model.
Yep.
So now the new rule for us is no single obligors for ABS. Now you can see how many obligors are in each portfolio as
Yep.
part of that market standardization. Now, on the flip side, we had a lot of small business exposure during COVID. That's just been fascinating to watch. So prior to COVID, the average rate for a small business lending deal was like 10 to 11%. That's what investors
Yep.
were comfortable with earning. The moment COVID hit, April 2020, I mean, I'll pose it to you. Would you want to invest in a small business lender in April 2020 when all the businesses were shut down? Probably not, right? So investors were saying, I need to be compensated way more for the risk that I'm taking here, if that's the case.
Yep.
So we saw a 7% increase in cost of capital. So APY went from 11 to 18% effectively in like
Wow.
9 months. That's unheard of. But the borrowers still performed. They knew that they could refinance it out. If they can make it through, PPP loans are coming, it's going to be okay. They can then refinance it down over time. That's kind of the beauty of private credit. So it peaked in like Q1 of 2021. At that point, then all this stuff started to come back. Businesses came back to life. And then the rates came down. So it went from
Yep.
18 down to like 15, right? Which is not bad. Not as good as it was pre-COVID, but still way better than 18. But now the Fed raised rates again, we're back up to like 16, 17. So it is almost like a real-time reaction to the market and conditions. And that's when investors are dictating sort of what they want. Now, the boom cycle that happened, I guess, slightly post-COVID, effectively, was not great for us as a company in the sense that every other asset class was the sexiest asset class on the street. Like there was pictures of monkeys that were way more money than we were doing in private credit. It was a far better investment per se. People were throwing darts at it, were making money. I was just like, am I in the wrong industry? Like we have like real assets here, things that are actually performing, but man, 12%, 15% is not enough anymore because these crazy people are earning like 1,000% in 2 weeks.
Yeah.
It's just like,
Yeah.
oh geez. So we roughed it out, right? We were not attractive as an asset class. But then when the market turned, we became the hottest deal on the street. And it all culminated in that weekend with SVB when it went under. Because in that weekend, we had several hundred startups reach out to us and our partners saying, I need bridge financing. I'm not going to make it. So the payroll cycle on Monday. In that instance, we had underwriters who were ready to go because they've worked with us before. They know our structure, they know our technology, they know how to use it. And we had investors slash lenders who said, I want to support the ecosystem. This is like a risk-free trade for a week because the Fed's not going to let this thing go under, guaranteed. So by Sunday afternoon, before the Treasury Department made their announcement, we had like 25 startups, give or take, with 50 million in capital ready to go by Monday morning, like in a 36-hour time frame of like just figuring this out. That was a great test for us to say, did we build infrastructure that can scale? Did we actually create something that could actually work here when all three sides are motivated to work together? The answer was a resounding yes. And at that weekend too, as well, I think every VC learned what private credit was because they definitely didn't know what it was before. Because they were calling LPs being like, can you guys provide debt financing? They're like, I do equity. I don't give you debt. Like, I can't help you here. They were just like, should we put existing capital? We're like, what's the answer here? The answer is private credit. You move faster than a bank does. This is non-bank lending. This is how it works. So we got a ton of interest in us as a company after the SVB weekend, and it's continued till now, basically, because you're still seeing banks fall apart left and right. But SVB was the one that obviously had the biggest impact on the startup ecosystem. Like PacWest or like First Republic, those are more, I would say, consumer banks than they are startup banks. So it's different. But yeah.
It's kind of like a trickle down effect, right? That's happening right now. Consumers are scared, or retail investors are scared, and everyone's just pulling money out, and that's leading to bankruptcy. But that's crazy. I did not actually put that together, that you would have been the alternate lending source in that situation. And actually, that's perfect product for you guys. Short-term lending, you're supporting the ecosystem. I was talking to a bunch of founders during that time, and a few of them were like, yep, we actually missed payroll. Luckily, the pain was short-lived, and the Fed stepped in. As you said, if they let banks go down, then say goodbye to America, right? So coming out of this, are you in the midst of launching different products? Because right now, I feel like in times of duress or uncertainty, there's also like a lot of opportunity, right? And I feel like you guys might be in a place of opportunity where people are pulling their money out of banks and they're looking for a more stable place to put their money. Or I don't know what exactly would be stable out there, because at the same time, if you put money under your bed or something, you're losing value by the minute. Are you guys thinking about that strategically in terms of what that ecosystem might look like?
I think the beauty of what we created here from an infrastructure standpoint is that a credit deal is a credit deal is a credit deal, no matter how you do it, right? There's always going to be the same core workflow. There's always going to be the same core structure. So everything we've done on the standardization standpoint for market structures and deal structures and also asset performance structures and ontologies, all that still holds true no matter what environment we're in. So we're well positioned on that front. What we're liking in terms of what we're seeing is that in the same way that after the global financial crisis, the banks got regulated like crazy. They were basically pared back from a lot of different things they could do before. You're going to see that again this time. I mean, SVB's literal model was, I will give you good terms on venture debt if you put your deposits with me. That sort of correlation is not going to be allowed anymore. That's just not correct. So if that's the case, you're going to see a drought of liquidity in terms of helping a lot of these companies when they need it the most. That's when non-bank lending steps in once again to be able to support that ecosystem. We're seeing that right now. Venture debt is so hot at this point, and we have plenty of underwriters, including very large banks, who are looking to help and be able to provide that. But they also are a little bit discerning as well, because they're not here to bail out companies from disaster, like who have 2 months of runway. They're here to support companies who can make it through this next, call it 3-4 quarters, right? So good companies will survive, bad companies will not. The good companies will be able to get the financing they need, albeit on expensive terms, because it's an investor's market right now. It's definitely not a borrower's market, that's for sure. But that story will change, as it always does. It kind of goes in cycles and waves all the time. So either way, we like how well we're positioned because we're neutral at the end of the day. High rates, low rates, high frequency transactions, low frequency transactions, doesn't matter. As long as transactions happen, we do well.
Interesting. I've been thinking about this potential shift. I don't think it's actually going to happen, but it would be very interesting if it happened, where there are a lot of newly accredited investors or accredited investors who are less sophisticated in, let's say, the lower income bracket of the accreditation bracket, right? So you have like family offices and ultra high net worth on one side, and then you have people making more than 200K on the other side. I've been thinking about this model about be your own bank, for example, right? So essentially, what does a bank do, right? They take your money, they lend it out. You are providing a non-bank lending service. And there are other alternate investments out there. I was talking to a friend about this when SVB happened, or like, oh, are people going to pull out their money and maybe manage their own money as a bank? Could that be a push? I actually don't necessarily think it could, but it was just an interesting thought.
It's definitely an interesting thought. I think crypto was probably the first to try and do this. And
Mhm.
like you can like unbank yourself with Celsius and things
Yeah.
like that. And then you realize they're kind of just a
Right.
bank. They're literally a bank, but worse because they don't have regulation. So that didn't really work out according to plan. I think the challenge here is that the financial literacy in this country is not high enough to be
Yeah.
able to allow people to reasonably and I think safely be their own bank. I don't think it
Yeah.
works quite that way. So that's the biggest challenge I would see. I think the beauty of where we are today in the cycle is that there has never been more optionality for investors and allocators, right? There's so many different assets out there that they can put money into. If you can do your own research and get comfortable behind it, you can do really well. And you'll be able to find alpha in places that others can't, that just simply weren't as easy to access before. The
Yeah.
days of putting in like, oh, here's my 250K into KKR's like private equity fund. This is my 250K into Blackstone's private credit fund. Like that's not there anymore. You
Yeah.
have way more optionality. You shouldn't just dump it all in one place because those guys aren't delivering returns that are outpacing inflation. Like they're
Yeah.
barely beating it because the funds are so large that
Yeah.
they have to deploy into large deals, safer deals that just don't have that return profile you're looking for, especially in this environment.
Makes a lot of sense. So one last thing I want to pivot to is we've obviously talked a lot about investments, alternate investments, credit markets. You've been in banking, in a non-banking lender now. So I'm curious to learn a little bit about your personal investing experience, right? So I'm assuming you have love for investing in general, but given what you're doing full time right now. So I'm curious what that experience has been and what your biggest lessons learned have been as an investor yourself.
Absolutely. I think my asset allocation strategy is not the same that I'd recommend for everybody else, but also because I tend to take higher risks. Because the way I look at it is obviously my future is tied to percent. All my
Yeah.
liquidity is effectively tied up in percent. For the ones that I don't have in percent or what I don't have in percent, I just like shoot for the moon basically because the worst case scenario is the money didn't mean anything to me anyway. Best
Yeah.
case scenario is make a return like 20, 30x. That's kind of the way I approach things. Or I move into an asset that I can't really sell very easily, which is also an option. But historically, I used to have stuff in the equity markets. I used to have stuff in my IRA and things like that. And I was just
Yeah.
like, this is so boring. Like, there's nothing I could do here that's all that interesting. I'll make 20% a year if I'm really lucky. Otherwise, it's like 8% a year. Others went down a year. Like, that's not that interesting. So I ended up diversifying more into two ways. One is in angel investments, which I have done quite a bit over the years. The check size have gotten bigger and bigger as I've become a little bit better. I've
Yeah.
gotten a little bit smarter. And that has returned pretty well, all things considered from a DPI standpoint. I'm actually pretty happy with that, even though each check size is like 25, 50K. It's still done
Yeah.
pretty well. And it's always
Yeah.
one or two return what you want. Everything else was a zero or just return what you put into it, essentially, which is
Yeah.
the normal VC allocation strategy. I've also become a big art collector over the years, especially post COVID. The art market and just art in general, I think is just really fun to be a part of because it's a real asset. It's a hard asset that sits on your wall, essentially. You can appreciate it. And even if it doesn't go anywhere, you bought it because you like the art. And so
Yep.
that's not a bad thing. Some of my favorite pieces are just ones that will never go anywhere from a price standpoint, but I enjoyed having the apartment. So that works out great. But that's been really great to be a part of. And now I would say in terms of my like percentage of my portfolio, it's more heavily in art because I can't move it that easily. Also because it's fun to have around. So that's been the strategy. My art investment as an investment strategy has done quite well, to be honest. Not as good as the angel investment side, but
Yeah.
definitely from just a straight portfolio return perspective. But again, it's like, what are you in it for? You're here to support the artist. You're here to support and have beautiful art on your wall. That's primary. And the secondary is what the ROI looks like. So it's been interesting. I've liquidated pretty much my entire equities portfolio. It's just not fun. So that's kind of the way to look at it for me, at least. But I wouldn't recommend it for everybody.
So absolutely, I wouldn't recommend that to everyone either.
Maybe anyone for that matter, but yes.
You have a high risk tolerance. So given your experience that you've had, what would you recommend to people who are just starting out or new to investing? Also thinking about public markets, private markets. If you were to give yourself advice, let's say you're starting out when you were 18 years old, what kind of advice would you give yourself?
Start first and foremost with the most liquid markets that are possible. That's the easiest way to get going, right? So public
Yeah.
equity markets is the best way to start. There's a lot of fun you can have these days versus before, like 18 years ago when I was doing this, like coming out of college. But being able to learn how options work is actually pretty interesting. I wouldn't do it like the, Reddit Wall Street bets way where you just go like YOLO into something on the day of expiry. Like that's probably not the right approach. But there is a lot you can learn from like a straight mathematical standpoint and just understanding the markets better and like
Yep.
momentum and sentiment, things like that. It's
Yep.
fully liquid, so you can get in and out fairly easily. You also have the most disclosure and transparency possible. So learn how to read income statement, learn how to read a balance sheet, learn how to read earnings reports, and that will teach you a lot. As you get more and more savvy, shift more and more into private markets, basically. But again, there are private markets that are more liquid and private markets that are super illiquid, right?
Yep.
Start more with the liquid side because you need to be able to have a way out in the event something goes south because nothing ever goes according to plan. So once you get really comfortable, go into the liquid stuff and then have some fun. But for the average person, I still recommend, depending on how much money you're working with, a heavier bend towards public versus private is still a better option just because it's hard to predict emergencies come up, what you need, things
Yep.
like that. You could go like me and go fully liquid the entire way, but like I just would not recommend that.
I love that a large percentage of your portfolio is in art. One of the things that I'm pushing for is invest in what you love, because if you love something, for example, art, one, you're going to actually dive into it deeper. You're going to be, let's say, at some point an expert in it because you love it. You're going to spend a lot of time in it. And you can learn about it from an investment standpoint too. So not only from an appreciation standpoint, but how does that appreciation work in terms of valuing a certain piece of art in this example. So I really like that's a large part of your portfolio. And I think more people who, let's say people love wine as a given example or spirits or whatever, instead of just drinking it, understand what the market dynamics are. Like, how is wine actually rated, for example? What drives the appreciation? Is it only weather? There are critics, there's the whole ecosystem, right? It's controlled by wine brokers too. So I feel like diving deep into an interest, one, it's a great investment. It might be a great investment depending on the asset class or whatever. But two, you also have a love for it. In your case, you like to see it on your walls. So it's
But
great.
this is my problem with fractionalized ownership too, right? Because there's a lot of platforms that, not to name names and bash anybody, but like they offer fractionalized ownership in like blue chip pieces of art or like
Yeah.
wine or like cars and things like that. If I can't see it and I can't touch it and it's like not actually mine, you don't get that same emotional feeling. That's my challenge with it. So you're almost like, yes, you're straight investing at that point. You're looking for appreciation
Yes.
because just because you own like a portion of a Ferrari 250 GTO does not mean that you naturally feel like that's yours. I don't think it does, at least. I don't know. Maybe for you it's different, but for me, it's just like, no, I can't physically go to a garage and see what I own and drive it away. Like part of the thrill and appeal is like being able to drive that and experience it, right? So
Yep.
I've had a hard time getting into fractional ownership. And even though I could definitely invest in blue chip art, for example, from a fractional
Yep.
basis, I'd rather invest in contemporary art that I can afford. I can put it on my wall because it just feels better at that point.
Absolutely. I think that's an affordability issue, right? My perspective is I think everyone should be an investor at whatever level of income, because if you invest well, if you study well enough and become sophisticated enough, over time you are going to grow that wealth. So it's more interesting, as you said, to like not only focus on equity markets where you might start off, but go into other markets as well. But let's say you aren't able to afford a full, let's say, art piece or a Ferrari or whatever it might be, but to feel like a part owner in something that you're interested in as well, without having the actual capital to fully back it, I think there's something there. And I think people would benefit from thinking of it from both angles.
For sure. That's definitely more of a me thing than anything else. So that's why I could never get into it, unfortunately. But yes, don't take my opinion as gospel for sure. It's still all good to have and experience and learn from.
Nelson, thanks a lot for your time. This has been amazing. I mean, this is the first credit platform that we have on our podcast. Really great getting to know you. Really great learning about Percent. Really great learning about your experience and your perspective. All in all, wish you the best of luck. I think Percent's in a very good place right now in terms of where the market is. Thanks for coming to the show.
Thanks so much for having me. It was a great conversation.
And that's today's value add. If you liked today's episode, hit that like and subscribe button. For long form written content, subscribe to my newsletter. Otherwise, say hello on Twitter. See you there.